In this video, I will give you two highly successful trading strategies to earn over $10,000 per month in the stock market. One of these strategies will be for buying stocks and the other for selling stocks. Don't worry, you don't need to have loads of capital in your account to implement these strategies. If you stick to the rules, execute your trades accordingly, and manage your risk diligently, you should achieve your $10,000 profit target with only a few $1,000s of capital. Let me explain. If you have only $2,000 or $5,000 in your trading account, you may well trade super stocks like Apple or Microsoft or Amazon. However, by doing that, you may not be able to buy more than a few shares with your money. If the stock moves in your favor, you will make very little profit. That will not take you anywhere towards achieving your financial freedom. Forget about the fact that you only have a 50% chance of winning a trade. Your account will shrink fast if consecutive trades go against you. On the other hand, you can buy a lot of shares with only a $2,000 account. If you trade small-cap stocks or penny stocks, they move fast and can double or triple your investment within a single trading session, provided you select them carefully and trade them following a winning strategy. These stocks often grow from $2 to $10 to $20 or even more, offering extraordinary trading opportunities. If you have only a 50% chance of winning these trades like before, your account will grow insanely fast within a few trading sessions. That is because you will risk only a small amount to win a big amount in every trade. Winning one trade will cover the losses of even 10 losing trades, and following these strategies, you will win more times than you will lose. According to the data we have seen, professional day traders make the highest amount of profit not by trading super stocks or mega-cap stocks, but by trading penny stocks, stocks under $20 per share, to be specific. If you believe in statistics, have faith in penny stocks. Embrace them. Study them. Master trading them. They are not losers. They will change your life forever. Trading strategy number 1. Going long. For this strategy to work, you need a stock scanner. You need a scanner that provides you with real-time data, not delayed data or snap quotes. See what kind of data packages are on offer from your brokerage firm or bank. A 15-minute delay in the price of the fastest-growing stocks is a long time for a trader. Hell can break loose within that time. Trading can be halted. Stocks can give away all the day's gain. As a trader with a big dream, you can't afford that to happen. Always use real-time data. If you must dream big, you better be a professional and have at your disposal trading tools that professionals depend on. There is no other way. I use the Interactive Brokers platform, Trader Workstation, or TWS. It is a professional stock trading platform available almost anywhere in the world, and it comes with a free stock scanner. You can receive up to $1,000 worth of free Interactive Brokers shares if you open a trading account with them by following my link. I set up the following parameters for the Interactive Brokers stock scanner so that it makes a short list of the right stocks for me every morning. Price: minimum $1 and maximum $20. Volume: minimum 5 million. Gains: minimum 50%. Only these 3 parameters give me a list of 15 to 20 stocks for trading. I am talking about the stocks offered by the Nasdaq and New York Stock Exchange. You can also add the maximum market cap as a parameter. The value will be from 20 million to 500 million. Not many billion or multi-billion-dollar companies double or triple their market cap overnight. Stay away from those companies for this strategy. Stay away from supermicro computers, MicroStrategy, or Meta. They are not for you. You need heavy volume in the stock you are going to trade. You want to get in and get out of your positions easily. You need enough liquidity in the market when you want to buy a stock at a certain price. You don't want to pay more. Similarly, you need enough buyers available to buy your stocks when you want to sell them at a certain price, or when the price hits your stop loss. You don't want to have a bigger loss, or you don't want to give away a part of your hard-earned profit. High volume also helps the spread between the bid price and the ask price remain low. If the ask price is $1.25, which will be your entry price, you don't want the bid price to be $1.17. You want it to be just 1 or 2 cents below the ask price so that you can get out with no slippage or your stop loss is not hit prematurely. If the stock sells at $1 and you have a $2,000 account, you will still not buy 1,000 or 2,000 shares in one trade. You will buy only 400 shares in one trade. For example, if the stock is trading at $2, 400 shares will cost you $800. That is your only investment in the market at any given moment. Do not disregard this rule. Your stop loss will be at $1.90 or closer, not any further than that. Your maximum loss from this trade is $40. If the trade goes against you, you will still have $1,960 left in your account. With that, you will be able to trade the same stock or a different stock from your watch list to be a profitable trader for the trading session. If the stock trades at $5, buy only 200 shares, as your stop loss may become bigger than before. Set stop loss at $4.80 so that your total risk for the trade remains the same $40 per trade. If the stock does not need a 20-cent stop loss, you may even buy 300 shares and risk roughly $40 per trade. Find out the number of shares by dividing 40 by the risk amount per share. That way, the trade will never go out of your control. If you fail to control your risk, the entire strategy will collapse. You will ultimately not be a profitable trader. You may earn $600 in one trade and then give away that $600 in the next trade. Your total income will be zero. Use a 9-period moving average to pinpoint the direction of the market. Buy the stock only if the price is above the moving average. We don't need any other indicators on the chart, since we are trading only unusually high gainers. The stock price will already be above the VWAP, or volume-weighted average price. It will also be above the 20-period, or 50-period moving average. But exactly how are you going to buy the stock, even if the price is above the 9-period moving average? Pay attention here, because this is not something that traders often do. You will use a stop order, not a limit order or a market order, 2 cents above the previous green candle to get into a position in the stock. That means your trade will be executed if only the price of the stock pushes higher than its previous swing high. That also means you will be in profit immediately after the trade is executed. If the price does not rise again, you will not have a trade, and your money will remain intact in your account. If a stock has risen from $2 to $4 and has fallen to $3.50 in the next minute, do not buy it at that price. Do not try to buy a stock at a lower price. $3.50 may be low, but the stock can fall more. How about below $2, its opening price? Instead of gaining 200%, can it lose 50% within an hour? Absolutely, it happens all the time. Buy the stock above $4. Wait until it reaches there to make a higher high. Buying low and selling high is not a winning strategy. If it were, 80% of traders would not have lost money in the stock market. They buy low, and then their stocks continue making lower lows until they lose patience with the market, lose a lion's share of their capital, and eventually quit trading. You want a different fate for yourself. You want a different future for yourself. You want to be a winning trader from now, from today. Don't follow the losers. You will become a miserable human being. Now, what is a stop order? It is a limit order above the market price, which triggers a market order at the stop order price. Market orders are fulfilled on a priority basis. That means your trade will be executed immediately at or near the limit price. If you have selected a high-volume stock, your order will be executed right at the stop price or a price lower than that. Maximize your profit from the trade. Understand that you may lose the next trade or the trade after. If the current trade is in your favor, bring the stop loss upward to lock in some profit. Do that diligently. Never let a green day turn into a red day because you did not adjust the stop loss efficiently enough or fast enough. As far as I have seen, maximizing profit from a trade is a big problem for the majority of traders. People cannot hold on to their winners, although they routinely hold on to their losers. They just can't. The psychology behind this is that they often lose trades and lose money. When they see some profit, they are afraid that the profit will be lost if they do not close the trade fast. Instead of holding a trade for a 70% gain, they exit the market with a 7% gain while holding on to their other positions that incur more than 70% of their losses. If you are able to trade from the chart, you can easily drag the stop loss upward. If that is not possible, use a trailing stop loss while placing the trade. The trailing stop loss command is available on all brokerage platforms these days. The only thing you do not do is trade without a stop loss. Even a $1 stock can lose 50 cents. That means your $400 investment may lose as much as 50%, or $200 if you do not use a stop loss. That will be a disaster because you can afford to lose only $40 per trade. Losing $200 in one trade would be like losing 5 trades in a row. That will be losing 10% of your entire account, whereas I am recommending only risking a maximum of 2% from a $2,000 account for trading these small-cap stocks. If the price rises far above the moving average, it will be gravitated back to it as traders begin to take profit. It is time for you to take profit too, but you still won't exit the market. You can never tell. The stock may still have a lot of upside momentum in it. You want to see the end of it. You want the market to take you out. In such a situation, you can raise the stop loss closer to the bid price. If a $2 stock is now selling at $2.70 and you want to close the trade, bring your stop loss as close as $2.67. You are now risking only 3 cents to gain another 3 to 5 cents or more. Raise the stop loss cent by cent after that until the market order is triggered and you are out. But if a $2 stock sells at $2.45 and you want to get out with a profit, do so with no hesitation. A profit is still a profit. It is not a crime to exit the market with a small profit. Nobody ever became poor by taking small profits. Thank you for staying this far with me. We still have a long way to go. It is an opportunity for you to take a moment to like this video and subscribe to my channel for more posts on money, trading, and investing before we start the second part of this tutorial. Trading strategy number 2, shorting. Not many traders I meet are interested in shorting stocks. There is a mundane consensus within the retail trading community that you make money in the stock market by buying a stock at a certain price and then selling it at a price higher than that. Truly speaking, that is only half of the story of trading or what trading can be. There are many traders who only short stocks. They consider it an art, a superior art, I might add. They sell a stock they don't hold, and return it to their brokerage after buying it at a cheaper price. The concept is as simple as buying stocks for equity appreciation. The difference is that in shorting, you sell first and then cover it by buying it back from the market when the stock depreciates. Since not many traders are aware of shorting, shorting still remains a mystery. How many traders have you personally met who said they only shorted stocks? How many non-traders or investors have you heard talking about shorting? Except for a handful of them, these penny stocks cannot hold their gains for more than an hour, a day or two. They do not have the solid fundamentals behind them to rise and lead an industry. They do not manufacture winning products or provide extraordinary services. They do not have classically recognized resilient leadership like Elon Musk or Jensen Huang at the helm to take them forward. They do not get strong press coverage as mega companies like Microsoft, Apple, and Amazon do. They must fall and fall fast. That makes them ideal candidates for us. We can make thousands of dollars by exploiting the opportunity of their bearish trend. This strategy will use much of the setup of the previous strategy. You will sell 400 shares at one time. You will sell with a stop order below the previous candle. You will have a stop loss 10 cents above the sell price. You will sell only when the stock is under the 9-period moving average. You will choose a gainer from today, yesterday, or last week and wait for it to show a specific weakness. The stock must lose at least 50% from its swing high before being considered for this strategy. If it does that, it will lose more. You just have to short it and hang tight. For example, a stock rose from $2 to $8 through a spike within a day or two. Now it must give away half of that gain before you can short it. That means it must now trade at or around $5. There are at least 3 reasons for a stock to fall that much within as short a time as a session or two. Traders or investors who bought it before the recent spike will continue getting out of their positions to lock in any gains left if they have not sold their entire position already. Many of the retail traders who bought the stock at the height of its gains, hoping it to rise further, will now exit the market with a 50% loss, thus forcing the stock to fall more. Not many traders are willing to buy a stock that has lost 50% of its gain within a day or two. If there are not many buyers in the market, there is no demand for the stock. Its price cannot rise. There may be small spikes here and there, but they are mostly caused by traders covering their short positions. If a stock has strong fundamentals behind its gains, it may fall 10, 20, or 30%, but will still trade close to its swing high. It is not a candidate for you. It may trade sideways for some time before finally falling, if it does at all, or go up once profit-taking is finished and when new buyers step in. These may take time, but what you don't have is time. For you, every session is important. You can't wait to move on to a new stock to add to your profit. And why not? There are gainers in the market every day, and losers. You forget a stock in the blink of an eye if it does not offer you a robust trading opportunity. You are not an investor. You are a trader. You don't see beyond today. Your entire concentration is on the stock that will make you money, not on the one that does not show you a clear path ahead. You are on the clock. You cannot do otherwise. You cannot fall in love with a stock. In my view, it is easier to identify stocks for shorting than for going long. There are over 5,000 stocks offered by the Nasdaq and the New York Stock Exchange. You do not know which 10 or 20 will be the highest gainers today, but you obviously know which stocks will be the highest losers. They mostly will come from today's or yesterday's gainers. If you go long on a stock today, it will be a candidate for shorting tomorrow or the day after tomorrow. Add this stock to your watch list so that you don't have to look for it. To summarize, to make fast money in the stock market, you will buy high and sell higher, or not buy at all, for long trades. You will sell low and buy lower, or not sell at all, for short trades. You will never, ever place a trade without attaching a stop loss to it. Practice these strategies with a small capital like $2,000 to see if they are effective for you. Gradually scale up your capital and buy more shares every trade to earn $10,000 or even more per month. Just remember that you do not risk more than 2% of your account at one time. If you take 2 positions, they should not exceed the 2% risk together. But my recommendation is you limit yourself to taking only 1 position at a time. Managing 1 position is much easier than managing 2. Trading volatile small-cap stocks requires your complete attention. A piece of warning: do not buy stocks as they approach major resistances, and do not sell stocks at or above their major support levels. Your chance of winning a trade will be drastically lower. How are you going to know where the supports and resistances are? It is not that difficult. If you understand the chart and have some knowledge of the price action, you can find them yourself. If you do not, go to the TradingView website, open a free account, and use an indicator called Support Resistance Signals MTF, created by Lux Algo. That indicator will show you the zones of support and resistance based on your time frame, which I imagine will be 1, 2, or 5 minutes. Keep an eye on the TradingView chart while trading on your brokerage platform. For long trades, get out of your position as the stock approaches resistance at a higher time frame, for example, an hourly time frame. Get out of your position when the price approaches a support level at the hourly time frame for short trades. That way, the market will not bounce back to eat up your profits.